Hello everyone, and welcome to this month's episode of Common Sense, where today we'll be joined by Tim Brumfield of Loan Central talking about some tips for the upcoming tax season. So stay tuned for all the juicy details. Good afternoon, everyone, and welcome back to Common Sense, the monthly TV show that we have here on cable channel 17 at Grande, sponsored by Ohio Valley Bank. And today we're going to talk about current issues as they relate again to the business industry and banking. So today we're going to be joined again by Tim Brumfield. You might remember Tim; he's joined us here before last year, and it's tax season, so we've brought Tim back again to join us and talk about some of those different things that relate to the tax and our taxes. It's time to get that done. So, beautiful day outside, Ryan.
It is.
We came through rain, snow, sleet, rain, snow.
Once we get sunshine, I think it'd be safe to say we
hopefully
maybe hit all 4 seasons in one day.
So. We've had 3 or 4 different ones on the way, and some of them 2 or 3 times.
That's right.
So, it's a little bit different out there, but we all made it here safely.
We did.
Everybody should be at home watching us today.
That's right. All the schools are out.
All the schools
Local
are closed.
schools are canceled, so we should have a large audience today.
But today, Rio Grande's operating on a full schedule.
And Ohio State.
And Ohio State, so we're all here working.
That's right.
That's right. Well, good deal. Well, Tim, welcome back again to the show.
Thanks for having me today.
We are glad to have you here as always. And, again, for maybe some of the folks that don't remember, our show last year, why don't you start out by telling us a little bit about some of the different things you do with Loan Central and maybe your history there and how you got to the point where you're at right now.
I work for Loan Central in Gallipolis. We're in the Gallipolis marketplace next to Walmart. We're a consumer finance company that's been around since 1996, and we've been doing income taxes. This is our 20th year, and so certainly in the winter months from January to April, we're pretty busy with income tax filings, and so that's what we'll be talking about today.
Sure. How many Loan Central offices do you have in Southern Ohio?
We have 6 offices in Southeastern Ohio. Yeah.
Okay. Mm-hmm. Sure. Well, as we mentioned, it is tax time, everybody's favorite time of the year, and there's this magical date that's put out there every year. Usually we hear it as April 15th being the deadline. Is that true?
Well, this year that's actually not true.
Okay.
This year the deadline is going to be April the 17th. The reason being the 15th falls on a Sunday, and the 16th is actually a holiday in the District of Columbia, and so the IRS extends that date one more day until Tuesday, April the 17th.
So we get a bonus 2 days.
Get a bonus 2 days to get them filed.
So we don't have to have them done by the 16th. That's good.
That's right.
One more.
That's right.
Good. So anyway, let's talk a little bit about the requirements of filing income taxes. That's the one thing they say. Or 2 things are certain in life: death and taxes. So, what's a situation where you would not have to file income taxes?
Okay, a lot of times if your income is below the filing threshold, in other words, you have a very low income, you may not be required to file. However, there's a lot of instances, even for those folks, if they are below that filing threshold, that they might want to file a tax return to claim the money that they've paid in throughout the year in their paychecks to federal income tax, or possibly if they qualify for some other credits, refundable credits, where they might be due a refund from the Internal Revenue Service.
Okay. So what if, for example, I'm an older individual and I'm on Social Security. Mm-hmm. So am I still required to file a tax? Is that taxable income, or is that already pre-taxed? Or
that depends. It depends. There's a formula depending on your filing status, where all of your other income besides Social Security is added up, mm-hmm. and then in addition to that, half of your Social Security benefit. If you're a single filer and that amount is under $25,000, then none of your Social Security would be taxable. Now, the other income you have may be. If you're filing a joint return, then you do the same thing. You add both persons' all their other income, and half of their Social Security. And then the threshold is $32,000. If it's under $32,000, none of the Social Security would be taxable, but the other income may be.
Okay.
Okay. Yeah, and as we're talking today, our conversation mainly relates to personal income taxes.
That's
not
correct.
business.
That's correct. Right.
Yeah,
We
okay.
handle individual taxes. We don't do business.
Sure.
Okay.
So, what advice would you give to someone that's maybe hiring, and
Looking for
the
a
first
prepare
time.
for the
Yeah.
first time. I think word of mouth is pretty important. Most people they have friends and they can talk to their friends, and maybe their friends have had a good experience with a tax preparer, or possibly maybe a poor experience.
Sure.
And would be able to tell them maybe whom to avoid. But I think even over and above that would be maybe asking some pointed questions to your tax preparer, like how long have they been in the, what is their experience level, what is their training,
Right.
how long have they been practicing their craft.
Sure.
Right.
Now, how many folks do you have on staff that can assist with
Well,
preparing
in my
taxes?
local office, we have two,
Okay.
which is in our 6 offices in southeastern Ohio. That's pretty standard in each
Sure.
branch. We just have 2.
Okay. And then all the other Loan Central offices also provide the same service?
They do,
Okay.
yes.
Yep.
Okay.
All right.
So, whenever I'm making that first trip to a tax preparer for the first time and having somebody assist me, what are the materials or the papers that I'm going to need to bring with me for you to help me complete my tax application?
Well, certainly we're going to want you to bring a photo identification, be it a driver's license or state-issued ID. We're going to want you to bring Social Security cards for yourself and any dependents that you might be claiming, and then all of your financial documents, whether it be W-2s, 1099s, 1095s, which detail what insurance, your health
Right.
insurance that you've had, and anything that might be relevant to your tax filing. We're gonna need that.
So, and especially some people, new into the game of filing taxes and having somebody assist them, if they've purchased a home, they'll probably need some interest statements for their
Correct.
mortgage. That can be,
That's
there can
correct.
be some
Your
financial
bank
benefits for that
your
as
bank
well.
will usually send you a statement of the interest that you've paid. Also, if you've possibly you might have paid points on your loan, and in that case, that can be a deduction if itemization is in order. You can deduct those points over the life of the loan. So.
Okay.
Just make sure to bring all that documentation with you. Also, the real estate taxes that you've paid as
Right.
well.
And typically institutions are required to have that information to the individual. I mean, that's required for them to mail that out by the 31st of January.
That's correct.
So
That's correct.
you should have already gotten, by now, it's
If-
week into February, you should have
If
already
you haven't received it, you may want to contact your bank.
Okay.
And that would be the same as savings accounts, interest-bearing checking accounts, those kinds of things as well.
That's correct.
That could be counted as income, not just deductions.
That's correct.
Yeah. So, if you're married, you hear a lot of talk of filing jointly versus filing single. Can you explain the difference in that and
Sure.
maybe some benefits of
Sure.
filing either way?
Certainly, it's going to depend on the situation that you have. It's not like there's always one right answer or the other or of what is best. But oftentimes, there are certain credits that taxpayers may be eligible for that it would behoove them to file jointly that they might miss out on if they were to file separately. For example, if there are children in the home and your taxpayer would be eligible for, say, the earned income tax credit, or possibly there's someone in the home that's furthering their education by going to college and wanting to take advantage of one of the education credits, then you're probably going to be better off filing a joint return in those situations. If those situations do not apply, there are times that filing separately does make sense and can lower the tax burden that a married couple might have. There are also instances where filing separately might be something that a couple might have to do in the case of if their couple is married but possibly separated, and they might not live in the same home anymore and be forced to file separately if they're not willing to file together.
Right. And that decision is as simple to make as, you know, if they have someone like you help them prepare their taxes and using a certain software system, it's as simple as just checking a box and comparing it one way versus the other.
That's correct. We can, you know, if anyone that would come in that would want to look at both ways to see what would be better. Obviously, that's why we're there. We want to be able to get back the best refund possible.
Sure.
You know, obviously within the law for our customers.
Sure.
Right.
Yep.
Oh, absolutely. Absolutely.
Well, and I would just add to that that it's always good to have a second set of eyes look at that, because as you know, we go in, we file our taxes, and it gets run, you know, 5 different ways to see what is the best benefit to us. But we know that it's being done correctly.
That's right.
That it, I would say it takes the liability off of you completely, but it certainly gives you a better feeling about it.
All right, and it's really important, you know, as we tell all of our business clients that we work with businesses, is, you know, hire an accountant or somebody that knows what they're doing to prepare your taxes.
Absolutely.
Because, I mean, you can look at something 5 times and overlook something very simple that can be hundreds of dollars of benefit to you in the long run if you have a professional look at it.
Yep.
So it definitely.
I know we're talking about personal taxes more so today, but I know last year it was an interesting catch on our accountant's end was about sales tax and internet, buying things over the internet.
Yes.
You know, if I'm filing that myself, I don't catch that as far as
right.
you know, if you ever get audited, you would basically have to prove that you've not bought anything over the internet.
Right.
And so we just, you know, estimated the best number we could come up with.
Sure.
But
Absolutely.
yeah.
Well, it's time for a quick station break.
Sure.
So we're going to do that, and we'll be right back here in just a couple minutes with Tim Brumfield from Loan Central talking about taxes. All right, welcome back to Common Sense with sponsored by Ohio Valley Bank. Again, we're here today with Tim Brumfield of Loan Central talking about taxes. And Ryan, our next topic on our list here is something that's, you know, we'll get into a little bit, but we're not going to get into a lot of detail with it. But the whole issue of who can be claimed as a dependent for you on your taxes. And we know currently there are some tax benefits and tax savings to having as many dependents as you can add to your tax. We understand that might be changing a little bit next year, and dependents may not be quite as important as they are right now as far as deductions. But Tim, could you talk a little bit about what might qualify an individual to be claimed as a dependent?
Sure.
Okay.
Most of the time, I think when we think of someone who's a dependent on a tax return, it's kind of intuitive of who that might be. Someone that's your son or daughter. Right.
That's the first thing that comes to mind.
Yeah, maybe your grandchild or niece or nephew possibly lives with you.
So you also think of minor, you know, being under a certain age as well. Right.
Yeah. Typically, it's under age 19, but if they're still in school, like college, it can be under 24. This would be someone that generally speaking, we're talking about someone that lives with you, that you're providing care for and providing really more than half of their support. Sometimes though, maybe we might not think about certain dependents or certain people as dependents. Could be someone that maybe isn't related to you, but has lived in your home as a member of your family all year, and maybe they don't have any income to file their own return, and someone that you're providing care for, that person could be your dependent on the tax return as well.
Okay. That brings up a good point. Can dependents have earned income themselves?
They can, and they can still be your dependent, depending, a lot of times this depends on their age or their status as a student. There's a little bit more flexibility of who can be claimed as a dependent if they're under 19 or if they're still a student. You know, providing that they're not providing more than half of their own support, and they live in your home. Now, if they're 19 or older and not a student, then this year, if they make more than $4,050, even if they've lived in your home all year and you've provided care for them, you're not going to be able to claim them. They have to claim them their own exemption on the return,
Right.
on their return.
Okay. Well, good. You know, we're here today at Grande. We do have some students in the studio helping us run the AV equipment and such, so we appreciate them being here. But are there any tax credits or special credits that are available for students?
Absolutely. Probably the best education credit for post-secondary education is known as the American Opportunity Credit. And the way that's calculated is you take the net eligible expense for a college student. Basically, you take what they've paid in tuition and required fees. You have to subtract any scholarships or grants they've received, and then you can arrive at your net eligible expense. $4,000 of expense can reap a credit of up to $2,500 on a tax return.
Okay.
Oh, wow.
So it can be quite lucrative for whomever is claiming that student as a dependent on their tax return.
So it's good for parents to keep track of, you know, obviously keep your tuition bills, keep supplies, materials, books, any of those things?
So, books count, and required supplies or required fees to gain admission to your program of study.
So receipts of those things would be important to bring to the accountant whenever you're having your taxes
Absolutely.
prepared.
What about living expenses?
Living expenses are not counted in that, such as like room and board, or you know, we get a question a lot about, well, what about expense in commuting back and forth? No, those aren't eligible expenses as defined by Internal Revenue.
Can't deduct mileage for that.
Cannot deduct mileage for that, no.
So, and one thing for students who might have a part-time job, it's important for them to file a tax return on that income.
Right. Even if, you know, we mentioned earlier, you know, possibly that parents could still possibly claim that child because they are a student, even if they're 19 or over. Still, you could have a situation where a student works maybe a part-time job, has had federal tax withheld, and they want to get that money back.
Right.
They can do that without claiming their own exemption, and their parents could still claim them as a dependent on the parent's return and claim the education credit on the parent's return.
Yeah, so it's my understanding if that money is kind of tax-free, well, not tax-free, but they don't really have to pay a tax until up around $6,000 of
That's correct.
income.
Yes, that's
So-
correct. If they're single, then the single filing status would be able to take out their tax liability on that.
So that'd be a nice little bonus for some of those students. That's an incentive to file that tax return.
Absolutely.
$200 or $300.
Yeah, and we've talked a lot about deductions, and of course everyone's looking for every deduction that they can find throughout the year. What are some of the most overlooked deductions, or some underused deductions that you may see come through your office?
I would have to say, you know, the tax code allows for saving money for your retirement, and whether that be an IRA account, if possibly you're someone that doesn't have a retirement account through work, or if you do have a 401k where you work, putting money in that retirement account not only can lower your income that you pay tax on now, but also on your tax return, in certain situations, you can get a credit for putting that money away. And then as an added bonus, of course, down the road, when that person retires, they're going to have more money in their retirement account.
Sure.
So even in the case of an IRA, you can make a designation even in 2018 up until the due date in April for the tax return.
Still go back on.
To still go back on
17
17. Sure
Yeah.
can.
Okay.
Okay. Well, we know at Loan Central, you do prepare taxes for individuals,
That's correct.
and you also offer a loan against that refund.
We
that they
do.
might receive.
We do. A lot of times, and especially we see this with some of the delays that the IRS is having, and then of course also, you know, kind of a big item in the news right now is, you know, possibly a government shutdown, or we don't know if that's going to happen or not. Would refunds be delayed? Well, that's hard to say.
Right.
And so a lot of times people may want to get a refund loan against their anticipated refund to help them meet their expenses instead of having to wait for the IRS to actually process and send the refund.
Sure.
Okay.
And you did mention earlier that some refunds are being delayed purposely till a certain date. Is that like
That's
February
right.
15th?
February 15th is when refunds with earned income credit, additional child tax credit, or the college credit I mentioned, American Opportunity, they won't be released before that date. That was
Okay.
a law that was signed in December of 2015.
Okay.
So that's not that anything with of current events happening, but that's something from a law from a couple of years ago.
Okay. So a little bit more about the loan that you do offer. There is no interest on the loan.
That's correct. It's
Yeah.
it's just a fee based on the size of the loan. The interest rate on it was 0%.
Yeah,
So
for many
depending-
factors.
Right.
Yeah.
Just depending upon the amount that a person would choose to borrow would be what their fee would be.
Sure. Okay.
So, and obviously the folks at your office, and you're trained by the IRS, you go to their workshops, so you're
Right.
you're fully vested in all this. When people get refunds, what's kind of the average refund that's out there? that
I
people
think
get?
nationally the number is about an average of $3,000 refund per return. And as far as what they would do with those refunds, I mean, a lot of times, like I mentioned earlier, maybe it's pay some bills or possibly take advantage of a sale or buy the latest phone. Who knows?
Yeah.
Right.
Now, with that, I know we also talked that some people may deduct extra money from their, or have extra money deducted as the year goes on and kind of use this as a savings account.
Right. Some people may prefer to receive a larger refund at tax time and maybe use it for a special purpose. Maybe they want to go on vacation and they feel like if they got $20 or $30 extra a week, maybe they wouldn't be able to save that.
Right.
But if they get it at one time, then they've got the money, and who knows, maybe go to the Caribbean for a week.
Sure. Does Uncle Sam frown on that?
Uncle Sam does not frown on
Okay.
that. That is to have more money held out is kind of like an interest-free loan for Uncle Sam.
That's right.
So,
Yeah.
yeah.
And I've always heard that too, that it's kind of a double-edged sword. It's nice to get that bigger return at the end of the year, but at the same time, you could be using your money to work for you throughout the
Money,
year.
Right.
That's
So,
true.
yeah.
That is very true.
Yeah. And I guess that's one of the things, I honestly, frivolous spending is not good in any way, shape, or form.
Right.
But, obviously the government likes that because it stimulates the economy, it makes things happen. And, just as in, October, November, we're bombarded with political commercial ads.
Right.
In March and early April, we're bombarded with, spend your tax refund here ads with all
Yeah.
these different businesses. So
That's
we'll
right.
start to see those come out. It's part of the marketing campaign of a lot of businesses this time of the year is looking for that injection into their,
Oh, yeah.
into their
That's
business. So
Well, and I think you bring up a good point with the political ads and whatnot. What we're talking about today is the current existing tax law. It's not
That's right.
what goes into effect. You might mention that.
That's right. Of course, around Christmas time, President Trump was able to sign into law the tax cut, and there's going to be some major changes for the 2018, which of course we'll be filing at this time next year in 2019. And so, there's a lot of details to that. Right now I'm still in 2017 mode,
Yeah.
but certainly from what you can hear in the media of what's contained and what a lot of the changes are going to be, there are going to be some differences and some changes that everybody in the tax industry will need to be educated about and updated about going into next year.
right.
Yeah.
And we do have a note on here that you did talk about some delays in the returns, but the government is doing some different things to help, identify and verify Social Security numbers, and the people that are filing are who they are. I know in the past, the state of Ohio has requested you to go in and verify through different things, even once your return's processed.
They have, and this year they've kind of taken that one step further. They're asking for, if you have a driver's license, to record your driver's license number, the date it was issued, and the expiration date, to help them in this battle of identity theft, to verify that you are who you say you are.
Right.
Okay.
So again, that's another piece of documentation. You
That's
don't
correct.
go without your driver's license because
right.
you will need that number, expiration, and
Your
date.
driver's license or state ID card.
Yep, that's
right.
all got to be a part of it.
Sure.
So,
Well, this has been a lot of great, helpful information again.
yes.
I know tax time seems to be a confusing time of the year, but if you can seek professional help and
Right.
make sure you do the right things and get it filed the right way.
Right. Well, it's one of those things, again, it's financial planning, and it's being prepared and thinking about decisions you make throughout the year to help get you to this point. And so, you know, it's really almost too late, except for some of the IRA things you mentioned.
Yeah.
But, you know, once that New Year's ball drops, you're locked in.
That's correct.
So,
Yeah.
all right. Well, again, Tim, thank you for joining us again. We really appreciate your insight and wisdom on this topic.
Thank you for having me.
All right.
Appreciate it.
Well, until next month, I'm Brad Bapst.
I'm
and
Ryan Mapes.
We're here for Common Sense. Thank you very much.